Okay, the clock's not working today, so it's like 1 minute too. So I'll check that you guys can hear all right. How's the sound over here? Is the sound okay for you guys? You fine? Fine. What about you guys at the back? You okay for sound up there? I think that was a nod. Okay. Are you guys okay for sound? Good. Right. Okay. I presume you guys in the middle are okay for sound too. Good. Okay, so today we're starting the second half of this section on the commercial banking. We finished the first half yesterday. Basically, we're looking at the structure of the balance sheet, how it works, and now we're going to look at it in terms of how a bank manages the risks that it faces, and also how it tries to remain profitable. And some of this, in fact, quite a big chunk of it actually overlaps with some of the stuff we covered in the previous topic on the regulation of financial institutions, where we looked at some of this stuff from a regulator's point of view. But ultimately, it's up to the bank to do the management of this, and so we're going to be looking at it from a bank's point of view even. But there is a lot of overlap between those two topics. So this is an outline. We'll have a bit of an introduction. Then look at, very briefly, some measures of bank performance, how they actually can measure their financial performance. Look at their income, then bank solvency and capital, which we've talked about before, but we'll cover again from a bank's point of view. And then the gap analysis, in that we're going to use the duration. So if you remember back to the section on bond pricing and interest rate risk, we covered durations. If you're a little hazy about what they are, how you calculate them, and how you use them, it may pay to brush up on that before we get to the gap analysis, because we do use the duration there in understanding the risks that the bank face. Then there's the hedging of interest rates. Basically, this is how they can hedge, either using derivatives or some other methods of hedging. And then, of course, the final slide. So the bank profitability, one way to look at this if we draw a picture of what their basic problem is we can put things on a spectrum, and we'll draw it horizontally. And there's three things that they're concerned about. One is liquidity, which we've talked about. Secondly is they want to earn a return, and again that feeds into their profitability. And the last thing is the safety of these things. And they range, if we think of it from a liquidity point of view, and we think of it from the lowest over to the highest, things that have very low liquidity would be something like, say, a 25-year mortgage, a very illiquid investment as far as the bank is concerned. Somewhere around the middle, you might have something like a AA corporate bond. There are markets for these things, but these markets tend to be a little bit illiquid, so if you want to sell it, you may take a day or two to actually sell it. And then, of course, when you go over to the very liquid stuff, a good example of that would be coins and plus notes, that you have. They're liquidity that's ready to go now. So that's looking at it from a liquidity point of view. When we look at it from a return point of view, the thing actually runs the other way, because this part of it here is your highest, and that goes going down, decreasing return as you go along. And then if you're thinking about it from a safety point of view, it runs the same way as liquidity. These are the lowest in terms of safety, and going to the highest over there. And so when a bank is running its business, unfortunately things don't line up quite nicely for them. So basically you've got to have liquidity, but you also got to have profits. And basically high liquidity means low profits. Low liquidity means high profits, but then you need liquidity, so you can't just sort of go to one extreme to the other. They've got to actually carry out some sort of balancing act to get these two things to work together. Because, as we said before, the two ways they can fail. One is that they can actually run out of capital, become insolvent. The other thing that can happen to them is they become illiquid, and if they can't meet withdrawals and so on, they run out of, they're out of business. So because of this problem, and it's a universal problem throughout the world, there exist these Basel Accords, which are the Bank of International Settlement actually facilitated the central banks of a number of countries throughout the world to get together and decide on uniform systems of bank management from a regulator's point of view, so that these types of problems could be managed. But of course, ultimately, it's not the regulator who decides. It is the bank management that decides what they're going to do in terms of managing this stuff. But then they have to report up to their regulator what they're doing. So when we look at the bank's performance, there's a couple of key measures, and they give very different numbers. And for example, here's the numbers from our system here. Put this up. So these come from the Reserve Bank puts out a financial stability report every 6 months, and this is the November 2016 one. So they put it out six monthly. There's supposed to be a new one out this month, but when I went to look for them, it hadn't appeared. So the first thing up, if you think about how you're going to measure the financial performance of the bank, first thing is up is you look at their return on the assets. And remember when we were drawing their balance sheet, here's their assets here, for example, you have your liquidity up here, here's your bonds, then big chunk of loans and some other stuff, is basically what sort of return are you earning on that? And this is the average across all New Zealand banks, and our banks are earning about 1.4% on the assets they have. And we can compare that to the OECD median and where we are overall. And this number here has been structured in such a way as number 1 is the best in the world, or best in the OECD, and number 26 is the worst. And in terms of return on the assets, New Zealand ranks about 8. So we're reasonably well up there in terms of the comparison with the rest of the OECD. Now, the other key way of looking at it is the return on average equity. And that involves looking at the other side of the balance sheet. So remember, we had the other side of the balance sheet, the liabilities and the capital. And up the top here was basically the equity, because the Basel capital measures include more than just equity. But equity is typically 3/4 of all the capital that the bank holds. So it's much smaller. And that's why these two numbers are really quite different. So when you look at return on equity, 18.6% for the average New Zealand bank. So that's quite a good return on their equity, whereas 1.4% on the assets looks very small. It's simply due to the fact that they're very highly leveraged. And in terms of overall rank, we're at 4th in the OECD. So our banks are doing quite well in terms of earning a return for their investors. And this data, this is released by the central bank on a semi-annual basis, but this is simply part of the normal reporting that a bank has to do to the regulator. So they do this on a regular basis, typically quarterly, and so the Reserve Bank has a very good idea, it's our main regulator, very good idea how the banks are going. In Australia, they would report exactly the same data, but it would go to APRA over there. So any question on that before we move on? Okay, everybody's happy? Good. Okay, so we're going to look at the bank income statements. So here is some data from the book. I also have some New Zealand data here as well, which I'll put up fairly soon. And there's some interesting things in here that if you just look at all the numbers, you think, well, it's just a pile of numbers. But they do tell a story if you start looking at them carefully. So in the 3 columns, the 2 columns of real interest is the big 4. So this is the 4 pillars, and this is all other banks put together. And one other thing to look at is, and you think, well, what do these banks do for their business? And most of us think, oh, well, they take deposits and they make loans. But in actual fact, when you start looking at the income of the banks, what you can see is that for the big 4 banks, that's true. But the other banks, basically the rest of the banks, they do other things to make their money. And how we can tell that is you look here. In one sense, this bit here about interest income and interest expense, It's much larger for the 4 big banks, and you thought, well, that's simply because they're bigger, and fair enough. But when we start looking at their net interest income, here it's about 12.2 billion versus 346 million. And then what we compare that with is the non-interest income, which is in this line here. And what you see is the interest income for the big ones is somewhere around about 2.5 times as much as their non-interest income, whereas in all other banks put together and averaged out, it's something like about a fifth. So there's a huge difference in how they're earning their money. So the non-interest income, essentially, most of that is fees of some sort, fees for services provided. And when you think about, in terms of the structure of the business, the big 4 banks are traditional intermediaries. They take deposits, lots of them. They make loans, they make lots of them, and that's how they make the bulk of their money. And when you look at the other ones, the non-interest income is sort of probably about five times as much as an interest income. And so what you see from what you can deduce from that is the fact that they're actually providing a lot of services. They are a bank, they take deposits, they make loans, but they're making the bulk of their money out of the services that they're providing to their customers, and they're charging fees for those. So if we look at New Zealand data, where's my New Zealand data? Oh, it's there. There you go. New Zealand data, this is just the ANZ. Again, what we see is traditional intermediated finance. And so we've got your interest income, interest expense up here, net interest income of $762 million, and that's for the first 3 months of that financial year. And then you put all the rest of the stuff together in terms of their other income, and it doesn't even go up by 200 million. So again, in terms of the structure of the bank's business, just by looking at that sort of table, you can see that they are a traditional intermediate finance bank. They take deposits and they make loans, and that's where they earn the bulk of their money for their business. Right. Any questions on that before we move on? Yeah, go ahead.
Just wondering for the banks, if they try to evaluate the project, how are you going to take out, say that the interest income is part of the operation income, so how are you going to separate that? Like, in the finance we use the operational cash flow, which is earning before interest and the tax.
Yeah.
Here, this interest is a part of the income, so how are you going to separate it?
Up the top there, there's interest income and there's interest expense. Okay, so there's, in terms of they're doing their business, this is like any other income from, this is how I'd say another business would earn its income. And the interest expense is simply like another company would be paying interest on the debt that it have. So the interest income minus interest expense, net interest income, in this case $762, is basically their core business. Whereas like, Toyota might have its core business of making cars. This one, its core business is making loans, taking deposits and making loans. That's its core business. And so the fact that it's interest, that is simply an expense. And in one sense, it's an interest on debt, and it's fully tax deductible. It's not conceptually different to another company having debt as part of its capital structure.
So you mean that if we work out the operational cash flow for evaluate the project, we have kind of take out this interest expense?
Well, you get the net one there. That's the key one there. There's your net interest income. So basically, this is your cash flow from the main part of your business. And then this other one down here, okay, there's your operating income and operating expenses, and you end up profit before credit impairment, income tax. Here is like your net cash flow there. That one, which I haven't highlighted, at 583 million. That's their net cash flow. out of which then they have some impairments, they have some tax, which is there, and then the profit after tax in this case is $393 million. Okay. It's not really any different to any other business except what they do is different. They take deposits and make loans. That's their core business. Okay, any other questions? Okay. So for the big banks, it's quite true there that the interest, primarily the interest, is where they earn most of their money. They do have a fairly significant chunk of money coming in from fees, but it is quite, in comparison to the money that comes in from the net interest income, it's relatively small in the large banks. But the small banks, it's the reversed, that their interest income is relatively small compared to the amount of money that they earn from the fees. Now, one thing down here about the margin being relatively stable, if you go back to the regulated days, it used to be it's 3% by regulation. But even now, when you look at what a bank does in terms of its margin, that's the difference between what it charges for its loan and what it costs it for its to get its funds. This is what they call the spread between the loan and deposit rates. Basically, the difference between what they charge for the loans and what it costs them to bring this money in. And for New Zealand, we're at well, written in basis points, 233 basis points. That's 2.33%. And so even after regulation went away, the size of that margin has shrunk, but it's not shrunk a lot. And I think where we are in terms of the rest of the world, we're 9th out of 20 on that rank. So some places have nearly 10% spread. Smallest is about 1.15% spread between the deposits coming in and loans going out. And in New Zealand, around 2 1/3% difference between money being brought in from deposits and other sources like money market securities, bonds, and so on. You average the whole lot up. Look at against the loans they've made, average those up, and on average the difference is 2.33%, 2 1/3%. So that number has been relatively stable over time. And if you think, well, what happens if interest rates change? Typically, if you think, here's your loan charges, what you charge your customers, and here what you pay, they tend to rise and fall like that. They tend to just, they go up and down together. So the bank makes sure that if their costs rise, they charge more for the loans, and then, conversely, as they drop off, they just stay roughly the same. So they manage that so that they always have this gap, but the size of it doesn't get much bigger or smaller as time goes on. It tends to be relatively stable. Right. So another expense for them. I'm not sure. Did I have that? Oh yes, I did have that got that for the New Zealand one. The other thing, one thing that you have as a bank is because you're making loans, typically some of those loans will go bad on you. And you can actually look in the statement, which is available on their website, is about how much they've actually written off. For example, here in the ANZ statements, the credit impairment charge here, for this 3-month period, they had $38 million of credit impairment. So that's basic losses. And of course, that comes out of your profit, because that's losses. You might ask, well, how does New Zealand fare compared to the rest of the world? Going back to our data from the Reserve Bank about how our banks are going, it's this one here. This is non-performing loans to gross total lending. And in New Zealand, at the moment, seeing this was late last year, 0.6% of the loans are problematic in one form or another. And as you can see, we're on the top of the world. We're number one. We have, economy's going pretty well. Defaults are low. So credit impairment is pretty low here. But as you can see, if you look around the world, The median's 4.4%, maximum 37%. I don't know what nation that is, but that's over 1/3 of all loans is impaired in one form or another, and the minimum, of course, is New Zealand at 0.6. So there's two dimensions, well, at least two dimensions. One is what's the economy doing, but also how well are the banks actually making loans in terms of their credit analysis of them before they make the issuance. And overall, at the moment, things are pretty rosy. But when you do get a loss, then you simply write that off against the loan loss reserve, which is part of your capital. So any question on that before we move on? Okay. So the non-interest income, which for the main banks is, well, it's a reasonable amount, but it's comparatively small compared to those other banks. It's basically the fees and the services and service charges. So if you see a bank service fee on your statement, this is where it comes from. And there's various things where it can come from. ATM surcharges. So sometimes if you pull your money out of somebody else's ATM, your bank or their bank gives you a charge. Credit card fees. If they're selling someone else's managed funds, they'll earn fees for that. Trust operations, that's basically they're managing money on behalf of their own clients, and any other services and products that they're selling on behalf of some other organization. Like, for example, they're selling insurance, but they don't have their own insurance company, then they'll earn fees for those sorts of sales. And in terms of non-interest expense, personnel, got to employ people. If you've got to rent your premises, you've got to pay for that. Technology, it's your computer systems, networks, and all that sort of stuff, administration. And it's fair to say that those have grown over time. So the cost, which you can see in the statements, let me see if I can find it again. Where is this one? Yeah. So operating expenses there, $369 million in that 3 months. So that's all that sort of stuff, just the costs of running the business. And as you can see, compared to 369 million here versus 789 million there for the interest, significantly bigger expense on the interest than on the operating expenses. And I think if you look back at that table that we had a few slides ago, you'd see pretty much the same thing with those big banks, that the interest expense is very large compared to the other ones. So let's go back and check that out. Yeah, again, if you look at the operating expenses here, 8.2 billion versus, say, the interest expense, it's not quite 3 times as big, whereas if you look at this one here, nearly 2 billion versus interest expense, expense, it's significantly larger. And again, that has to do with the differences in the structure of the business of these two types of banks. Okay, any question on that before we move on? Okay. Right, bank solvency. So explain the profitability versus solvency and liquidity dilemma facing bank management. Okay. So basically, this is summarize what we just talked about. Can anybody explain the problem that if you were a bank manager, senior executive, that you faced as a bank? What's your basic problem here? Ooh, being asleep, haven't been paying attention. Go ahead.
We just use the liquidity, for example. So if you hold a lot of cash, then you have significant liquidity. However, but cash is earning quite little return. So in this case, that you won't be very profitable.
Okay.
On the other hand,
yep.
if you hold less, you use the cash to reinvest a long-term project which have high return, then you have less cash in hand, which affect your liquidity of the business.
Okay, so there's the basic problem, in case for those who didn't hear it. If you grow the size of liquidity that you hold on your balance sheet, okay, That gives you plenty of liquidity, very safe stuff. It's not going to default on you, but it doesn't earn you much. And so what you're doing is you're squeezing out the high-earning stuff if you hold lots of liquidity. On the other hand, you think, oh, I'll try to be very profitable, and you expand the things that really give you the money, like the loans. It squeezes out your liquidity. And, of course, that can give you a problem if you don't have enough of that. And so that's the basic balance that the bank's got to face. By trying to become too profitable, they can run out of liquidity. By trying to be nice and liquid, they may become unprofitable. So that's the basic problem that they've got to face, and they've got to sort it out somehow. And so when we're looking about who cares about what, and you've got constituencies that are actually interested in different things. First up, shareholders. If you own shares in a bank, you want a nice profitable bank. So they can pay a good dividend and get capital appreciation. But the other two groups, the depositors and regulators, they're interested in safety. So people who put their money in their bank, they're not seeking a high-risk, high-return type investment. They want safety, and for that, they're prepared to accept relatively low risk. And so not only do you have to manage this yourself as a bank, but you've got competing interests that you have to take care of. Because shareholders, if they don't like you, they'll sell your shares and go down in price. But depositors, if they don't like what you're doing because you're too risky, they can simply go to another bank. And so you've got to balance the needs of all these people. So I've said about this before. If you suffer losses on your loans, you can end up insolvent. And where's our balance sheet here? Yeah. So when we made that balance sheet a day or two ago. On the liability side, typically the equity is pretty small. Sort of 7 to 9% is sort of like relatively normal, which means that 91 to 93% of the money that's been raised is here in your debt of one form or another. And so it doesn't take a lot of losses on the other side of the balance sheet. When you look at your balance sheet here, and it doesn't take a lot of losses over here to completely wipe out your equity. Like if you only say are carrying 7% equity, then essentially 7% loss here will put you into bankruptcy. And so there's a real balancing act to be done there. Liquidity, we said about that. Made this point before that bank illiquidity often leads to insolvencies because they get forced to sell loans at a loss to try to restore liquidity. Okay, so I think we said most of that. Okay, so we're going to look at how they manage liquidity, because there's actually two ways that they do this. One is they can manage it on their asset side, their balance sheet, and they can also manage it on the liability side. So we've probably explained the first one about why they try to minimize it. Basically, they don't make much money on this stuff. Now, what about the other one, though? The second one down there is liquidity management can be practiced on either side of the balance sheet. And how are asset and liability liquidity management similar? How do they differ? So when we're talking about this, they can manage liquidity on both sides of the balance sheet. That's the basic argument. But when we looked at the balance sheet, all the liquidity sat over on the asset side. So if we take traditional asset liquidity management, what are they doing when they're doing management of liquidity on the asset side of the balance sheet? Ooh, all very quiet. All right. Well, let's go back to our balance sheet, our messy balance sheet. So if we look at the asset side, there are assets they simply hold to give them liquidity, and we split them into two pieces. There's the stuff that is liquid, that is ready to go now, Example, notes and coins, reverse repos, accounts at the Reserve Bank, and there's other ones. But this is stuff that is liquidity, and if anyone wants to draw money out for any purpose, it comes out of here. Now, we also had what we call secondary liquidity, and what that is stuff that is not liquid right now. So you can't just go and use this right now, but this stuff can be turned into liquidity very quickly. For example, if you're holding, say, a money market security of some sort, say you have a bank bill that you bought from another bank, because those markets are very liquid, you can sell it very quickly and get extra liquidity. So if you have, say, let's put a bit, let's say you have a bank bill in here from another bank, and you sell that, then that transfers out of there and goes in, stops being secondary liquidity and comes into primary liquidity. So if you sell it, you get money, goes into your primary liquidity. So this is how it's been traditionally done. The management of liquidity has traditionally been done on the asset side of your register. Okay, so basically you hold what liquidity you need. You have another backup called the secondary liquidity that you can convert very quickly into liquidity as you need. And this is how it's being done and still is done around the world. Now, what about the next one there? How can we manage that liquidity from the liability side of our balance sheet? So let's put up this, there it is. How can you manage liquidity over here from that side of your balance sheet? Okay, let's think about this. Let's draw a picture of what happens. So what we'll have here, these will be our assets, and we'll make it fairly simple. What we'll do is just split it into three pieces. And so up the top here, we'll have some liquidity, and we'll put both lots in there, and then we'll have some loans down here. Let's put loans there, and then everything else down there. So what happens, for example, is if the bank makes a loan and somebody draws that loan down, what happens is that here's your new loan. So this bit here, you just made this new loan, and because it's a new loan, what happens is that the liquidity is shrunk. It decreased. And from here, the loans increased. Now, if you have strong loan demand, strong loan demand, so there's people coming in, corporations coming in, getting loans, what happens is that the very fact that you're making those loans tends to gobble up your liquidity. And liquidity, we've moved that from there. It used to be liquidity, now it's a loan, and so the liquidity shrunk, loans got bigger, and if you make another one, liquidity shrinks, loans get bigger, and if you keep doing it, your liquidity eventually would run out. So what you want to do, and we'll make the assumption that holding the amount of capital they have is sufficient, they don't have a problem with capital. If you have a strong loan demand, what you want to do is you actually want to expand both sides of your balance sheet. You want to actually make the balance sheet bigger because then you can make more money. So if we're looking at where this money comes from, on this side over here, by definition, the assets in terms of their size equals the liability plus capital. And looking at those pieces, if you want to expand the size of your balance sheet to accommodate this strong demand that you have for loans, what's the quickest way to expand your liability and plus capital side? Of all that stuff in there, what's the quickest way to raise more money? Should we go out and issue some more shares? Is it going to be quick? You can't.
Yeah, you can. That's one option.
Yeah, is it going to be fast or slow?
It's going to be kind of slow.
Okay, so it's kind of slow, so it's not the fastest one. What about deposits? You know, getting from mum and dad and type people. You're going to expanding your deposits. Is that a good idea? Is it going to be fast or slow, or can we do that? What's that? It's unreliable. Yeah, I mean, trying to expand that stuff. Yeah, yeah, you got to push your interest rates up, and even if you do push them up, whether they respond with enough money is questionable. So, typically, the deposits, they grow and they shrink slowly. Okay, so that's not a fast way of getting money. Well, what about going out to the money market, issuing some bank bills? Fast, slow, dumb idea, smart idea?
I think from the money market would be the fastest.
Yeah, that's right. It's the money markets that's the fastest. So if you need to pull in liquidity because your liquidity is drying up because you're making loans, the quickest way to bring more liquidity in and expand your balance sheet at the same time is to run out to the money market and issue some bank bills. Because typically, if you decide to issue bank bills, you can do it the same day. So you can pull money in that way. So this is the fastest way. So if you really got this strong loan demand, and you want to make your asset side of your register bigger, then the fastest way to put more stuff here on this side, which is where you get your money from, is to go out into the money market and issue some securities there to bring them in. Now, if you remember way back, when we were talking about what reserve banks look at when they're setting that cash rate, one of the things that we said they look at is the bank's activity in the money markets. And they look at them and see whether they are net issuers on money market securities or net redeemers. And this is exactly why they look at it. Because if they have strong loan demand, you may not have, as a reserve bank, if you're not the prudential regulator, you may not have access to the details on their loans, but you can watch the money market and see what they're doing. So if they're pulling money in from the money market, then that tells the central bank that they have a strong loan demand. And when you think about it, that's the fastest way to get new money. Certainly faster than issuing shares. Deposits tend to be slow in terms of growth and contraction. Issuing bonds, again, it's a slow process. But money markets, usually, if you decide to do it, you can do it in the same day. And so that's one of the reasons they look at this, because this is where they can restore the liquidity. So if liquidity is drying up here, when we talk about managing liquidity on the liability side of the balance sheet, it is primarily you assume that you can get as much liquidity you need by going out into the money markets. Okay, any questions on that before we move on? Okay, people okay? So, let's have a look. Probably got most of it. Yep. So we've said about those. So this is the basic assumption there. This is the liability management. It simply assumes that the bank can borrow its liquidity at will in the money markets. And basically, if you raise your interest rate a little bit above your competitors, you can pull in whatever you can. Now, that's a good assumption most of the time. It stopped working in the financial crisis, and it's precisely because of that problem that all of a sudden they couldn't raise money in these money markets, that reserve banks and other regulators throughout the world brought in what they call a core funding ratio, and basically they're looking at the ratio of funding which they consider to be stable versus that which is unstable, and the money market is considered to be unstable. But basically, this is the quick thing. So if you need to quickly change your liquidity position, either by you've got too much liquidity, you can let your own ones mature. But if you need more, you can simply borrow it, and that's how you do it on the liability side. So no one does it on this side alone. For the big banks, they often have a much better ability to do this than a small bank, but they certainly do not neglect the asset side. They actually manage liquidity on both sides, the asset side and on the liability side. Which brings us back to this question here, last one. Why do smaller banks have limited access to liability liquidity management? Why can't little banks do this?
Clearly, they have a problem to. It's more difficult for the small banks issue bank deals in the money market than the large banks.
Yeah, so the basic issue there is credit rating. Small banks tend to have lower credit ratings, and so their ability to do this is considerably restricted compared to the main four. So you see mostly for smaller institutions, they'll continue to do most of the liquidity management on the asset side as is traditionally done. And so the larger banks certainly have an advantage in terms of being able to pull in liquidity on the liability side. Let's see. Okay, any question on that before we move to bank capital, looking at it from a bank's point of view rather than just the regulator's point of view? Okay, all right, we'll move on. Okay. Okay, this should be a review. Define bank capital. When we're talking about bank capital, what are we talking about, and how do we split it in these two tiers, tier 1 and tier 2? What is this stuff? Oh, very quiet.
So it's the bank's equity.
Okay, it's not entirely the bank equity. Equity forms typically around about 3/4 of all capital. So it's like the biggest chunk of capital is equity. But there's some other things in there as well. Okay, and so when we're thinking about it, and we're talking about tier 1 and tier 2, tier 1, if you look at them, things like this, common stock, surplus, retained earnings, that's genuine equity. Some of these other things are not equity, but they count as capital. Now, here's an interesting one here. When you're adding things up, you take off your goodwill and your intangible assets. Why don't you count those in your capital? They got value. Why don't you count your goodwill? Yeah.
Because the banks normally evaluate the capital in gold customer. So those goodwills is only useful for the company.
Okay. Well, the basic point with those is that they're not cash items. Okay, they have value, but you can't access them. If you think about what capital is for in terms of writing off losses on your balance sheet, you can't write it off against something that's a non-cash item. And so even though if you look at a balance sheet, you'll see that stuff there, you can't use that for your capital. So it's specifically excluded. Let's see, what else? I go back. There was an point brought up in the other sector about this counter-cyclical capital buffer, and I've got something a little bit here about why this thing was brought in. So this is U.S. data, and this graph here doesn't look very scary when you look at it, but once you understand it, it gets a bit more scary as you go on. So this one at the top here is the one we're interested in, and what this is, it says there household debt, okay, household debt as a percent of disposable income. And we've got data from 1980 all the way up to around about 2011. And what we see is that the households were accumulating debt. So at this point here, 1980, they had about 70% of disposable income as debt. Okay, so if you take it, across the entire, millions and millions of households throughout the United States, and you look at the disposable income and say, well, how much debt do they have? What's the ratio? About 70% of disposable income, That would be debt that they had. And that's grown because there's a little uptick here, but you actually see a pickup in speed from about 2000. It actually starts to get bigger, and if you get up here, just before, here's where the crisis occurred, they're nearly at 140%. So it's nearly doubled in that time. And so what is happening is, if you think about what that means, let's say someone has $1 million debt. If they have a take-home pay of $2 million, that's not a very big deal, because that's like 50%. If you have $1 million debt and your take-home pay is $100,000, then it's 10 times your take-home pay, and it is a big deal. And so what's happened over time is that people have taken on more and more and more debt. And what we have seen not only in this crisis, but in many, many other crises over a long period of time in many different countries, is when you see a run-up of debt-fueled growth, and this sort of understates in one sense, it understates the actual size of the run-up, but on another level, you can see, like, from this period here, which is probably about 2001 to 2007, the peak there, they went from about 100% to almost 140% of their disposable income as debt. So there was this big debt-fueled binge, and of course, if you do that, you tend to end up with serious problems. And so the countercyclical capital buffer, which is part of Basel III, the actual capital itself is, like was correctly pointed out, it's actually, that was your point, that it's pro-cyclical. Basically, in the good times, you build up your capital, and you're allowed to run it down in the bad times. Now, what that does, if you think about the structure of the balance sheet that we have, here's my balance sheet here, is if you're requiring them to accumulate more capital, what that does, and this is the counter-cyclical bit of it, it restricts the growth of the lending. So by requiring to hold more and more capital in the good times roll, they increase the capital, that restricts the growth of this thing here, and it's supposed to counteract this problem that in many crises, if you look back before the crisis occurred, you see a debt binge. People are loading up on debt because it's good times. And the countercyclical buffer is there to try to limit this problem by requiring to hold more capital, slows credit growth, tries to get around this problem of these debt-fueled binges that go on that lead to big problems. Okay, any question on that before we move along? Still 25 to 4. How is time going anyway? 47, like we've got three minutes left. Okay. So the tier 2, this is your lower quality capital stuff, and so when you look at this, most of this isn't actually even capital in the sense that we normally consider it. Why would a loan loss reserve be sitting in tier 2? Why is loan loss reserves sitting in tier 2 and not in tier 1? Yep, go ahead. Okay, so it has to do with, people taking a loan, they may not pay it, right? Okay. Now, you're on the right track. The key point here is why it's over here is if you think about the economic purpose of capital, capital is there to absorb unexpected losses on your assets. Now, this one here, the loan loss reserve, what you do is you do your statistics about what you actually expect. And so if you think about capital as there to absorb losses from unexpected losses, this is actually there to absorb expected losses. And so what they're really expecting, they put this aside expecting that they're going to have to use this. And so although it looks like very good capital in one sense, it's because you expect to use this stuff up as loans go bad. And then if you look at our data here, 0.6% of your loans go bad. That's why it's sitting over in tier 2. And if you look at some of these other things, and we've mentioned this before in the previous section, things like subordinated notes and debentures, these are actually, and that one there, they're actually debt. So they're not capital at all in the traditional sense. And the problem with these things is it's hard to get hold of stuff if you need it. Okay. So that's another breakdown there. Actually, are we running out of time? Yeah, okay. Right. Probably have to pick it up around this point tomorrow. So if you want to ask any questions, be around for a while. Otherwise, we'll sort of finish this off before we get on the credit risk.
Goes into weekly things. Would that have anything to do with like the focusing on the capital requirements rather than like liquidity?
No, it is.
Is it more risk?
Let's see.